Welcome back to Investing Talk podcast. Today we're zeroing in on a really interesting name in the gold space, Alamos Gold. And the big question we're tackling, looking at all the material you sent over, is pretty straightforward, but really important. Is now actually a good time to consider buying into this gold producer? It's been flying high. We'll be digging into their recent financial results, checking out the technicals, the momentum there, and of course, looking at the potential risks you need to be aware of. Now, before we jump into all that analysis, if you find this helpful, please go ahead and hit that like button and subscribe if you haven't already. It really helps us out. Oh, and leave a comment below. We genuinely enjoy hearing what you think. And hey, if there's a particular company you'd like us to look into for a future analysis, definitely drop its name in the comments section. We do read those. All right, so Alamos Gold, it's been hitting new multi-year highs, which is definitely eye-catching. We really need to understand what's underpinning this success, what's the foundation, and maybe more clinically, does the current valuation still make sense given, the inherent risks in mining? Okay, let's start with the financials then. Usually in mining, stability is the name of the game, but the reports here seem to be, well, screaming growth. What's the actual evidence for Alamos Gold's financial health right now?
Yeah, the growth isn't just, robust, it's actually speeding up.
Mm.
So for 2024, Alamos Gold pulled in revenue of $1.35 billion. That's a significant jump, 31.6% year over year compared to 2023. And that pace didn't really let up. In Q2 of 2025, revenue climbed even higher to $438.2 million. That's an acceleration to 32% growth versus the same quarter last year. What's really compelling, though, is how profitable they are with that revenue. Their net margin is sitting right around 23%. That's pretty exceptional for a mid-tier producer. It translates to a trailing 12 months net income of about $346.7 million or 0.82 cents per share. Solid numbers.
Okay, nearly 32% revenue jump. That's huge in the sector. But is that mostly just riding the wave of higher gold prices, or are they actually, getting more efficient, producing more?
That's exactly the right question. Look, a good chunk of it is definitely helped by strong gold prices. I mean, their average realized price in Q2 was quite high, $3,223 an ounce. Can't ignore that. However, management's confidence speaks volumes about the operational side, too. They've explicitly reaffirmed their full-year guidance for both production and costs for 2025. And that's pretty important because, yes, they did face some cost pressures early in the year. Specifically in Q1 2025, their AISC was a bit higher then.
Whoa, hang on. AISC. For listeners maybe newer to mining stocks, could you just quickly break down what AISC is and why keeping it under control is so critical?
Oh, right. Yeah, good point. AISC stands for all-in sustaining costs. Think of it as the gold mining industry's benchmark for the true cost to produce 1 ounce of gold. It covers everything, digging it up, milling it, sure, but also exploration needed to keep the mine going, corporate overhead, essential capital spending, all of it. So when management sticks to their guidance, even after a bit of a cost bump in Q1, they're basically signaling, yeah, we think we've got this under control for the rest of the year. That cost discipline, it's absolutely vital for their bottom line.
Makes sense. Okay, so strong income, cost discipline seems okay. Let's pivot from the income statement to the structure. How stable is the company itself, looking at the balance sheet? Mining's tough, capital intensive. That's usually part of the picture, right?
Well, this is where Alamos Gold really stands out. It's why you could call their foundation almost fortress-like. As of the end of Q1 2025, they actually had a net cash position, about $40 million. They have practically zero long-term debt. Negligible. That's, frankly, highly unusual for a gold miner experiencing this kind of growth. Most peers are loading up on debt to fund expansions.
Net cash. Wow.
Exactly. And this financial strength, this clean balance sheet, it gives them enormous flexibility. They're not answering to creditors. This lets them fund their own significant organic growth projects, maybe look at strategic M&A if the right opportunity comes along, or keep returning value to shareholders. They've got a stable dividend at $0.10 per share annually right now, plus capacity for buybacks. And it's all backed by consistent free cash flow.
That net cash position, yeah, that's a serious competitive advantage in itself.
Yeah.
So beyond the cash, what else really defines their sort of long-term operational edge, their moat?
I'd say there are two main parts to it. First off, location. They're primarily a cost-leading producer, yes, but crucially, they operate almost exclusively in what are considered low-risk jurisdictions. We're talking Canada, Mexico, and the U.S. That gives them a level of operational stability that companies mining in, let's say, more politically volatile regions just can't easily replicate.
Right. That geopolitical risk factor is minimized.
Precisely. And second, they have a really well-defined pipeline for organic growth, and it seems efficient. The big one coming up is transitioning the ore processing from their island gold mine over to the nearby Magino mill. Now, this isn't just moving rocks, it's a strategic optimization. By consolidating the processing, they should get better economies of scale, lower cost per ton milled, and that's projected to significantly boost production starting around 2026. It shows smart, forward-thinking management.
Okay, so strong fundamentals, clean balance sheet, smart operations. Let's switch gears to the technical side. The market seems to agree with this positive story, judging by the stock price. What are the key technical signs telling us right now?
Yeah, the price action is undeniably bullish. Alamos Gold hit a new 52-week high not long ago, $34.40. It's pulled back slightly, trading recently sort of in the $33.50 range, give or take. But what's really important is the pattern over the last, say, 3 months. It's been a textbook series of higher lows and higher highs. That confirms a pretty well-established uptrend is in place.
Higher lows and higher highs, the classic uptrend signal.
Exactly. And from a trading viewpoint, there's some key support we can identify now. It looks like the zone between $29.50 and $30 is pretty solid. That level was tough resistance before, so breaking through it and now holding above it suggests it's become a reliable floor. Current forecast models actually put the stock trading within a bullish channel, roughly between $32.06 and $35.37 for this quarter. So that implies there could still be some near-term upside.
Okay, and what about things like moving averages or momentum indicators? Is the stock looking stretched, or does it still have room to run?
Doesn't look stretched yet. The stock is trading comfortably above its key moving averages. The 50-day is down around $29.56, and the longer-term 200-day is way down at $25.66. Maintaining that kind of separation, especially above the 200-day, usually signals that institutional money is backing the trend. It's not just a short-term blip. And then if you look at momentum, the 14-day RSI, that's the relative strength index, it's currently sitting around 39.96.
Okay, RSI at 39.96. For our listeners, what does that number actually signal? Is it hot, cold, lukewarm?
It's definitely not hot. So
Yeah.
RSI runs from 0 to 100. Generally, readings over 70 suggest a stock might be overbought, too much buying too fast, maybe due for a pullback. Readings below 30 suggest oversold. A reading near 40, like 39.96, is basically neutral, maybe leaning slightly towards underbought territory. It means the stock hasn't seen excessive buying pressure recently. There's, technically speaking, plenty of room for it to move higher before hitting those overbought warning levels.
So fuel left in the tank? Potentially.
Potentially, yes. And one other technical factor worth noting is its low beta. It's around 0.54.
Low beta, 0.54. Help us unpack that a bit. Why is that significant for an investor considering this stock?
Sure. Beta measures how much a stock tends to move compared to the overall market, usually represented by something like the S&P 500. A beta of 1 means it moves perfectly in line with the market. Alamos Gold's beta of 0.54 means it's historically been much less volatile than the broader market. So if the overall stock market hits a rough patch or gets really choppy, Alamos Gold theoretically should hold up better than higher beta stocks. It offers a bit of defensive resilience.
Less drama, potentially. Okay, so we've got solid financials, positive technical momentum. What's the word on the street? What are the analysts and the big institutions saying? Is there consensus here?
Yeah, the institutional sentiment seems quite strong. Looking at analyst ratings, the consensus is overwhelmingly positive. We're seeing 4 active analysts covering it, all rating it as a buy. That translates to 75% classifying it as buy or strong buy recommendations. Critically, there are 0 sell ratings reported.
0 sells, that's a strong signal.
It really is.
Yeah.
And this unified optimism is likely contributing to what looks like growing interest from institutions. You see it in the trading volume and the expansion of its market cap, which is now just over $14 billion. Plus, they got a nice bit of recognition recently. They were named to the TSX 30 2025 list.
The TSX 30 list, what exactly does being on that list mean?
So the TSX 30 highlights the 30 top-performing stocks listed on the Toronto Stock Exchange, specifically based on their share price appreciation over the preceding 3 years. For Alamos Gold, getting on that list reflects that massive 310% share price gain over that 3-year period. It's essentially a public acknowledgement, a stamp of approval, recognizing their sustained success both operationally and in the market.
Okay, 310% over 3 years, strong analyst backing. It all sounds pretty positive, but, we mess looking forward, not backward. What are the specific things, the catalysts, positive or negative, that we should really be keeping an eye on over the next, say, 3 to 6 months?
All right, near term, the big date is their next earnings report. It's scheduled for November 5th, 2025 for Q3 results. The general expectation, the consensus, is for very strong year-over-year growth to continue, largely driven by those sustained production levels and, of course, still elevated gold prices. Any upside surprise on earnings, or perhaps even more importantly, if they manage to signal lower AISC guidance for the rest of the year or next, that would likely be a significant positive catalyst for the stock.
So earnings beat or cost control improvements? What else?
We should also expect updates on their ongoing expansion projects, particularly how things are progressing with that Island Gold to Magino mill transition we talked about. And new exploration results are always key for miners. The source material specifically mentioned some really impressive new high-grade drill results, citing one intercept at Island Gold that hit 21.58 grams per ton of gold over about 5 meters.
Wow, 21.58 grams per ton. That sounds exceptionally high. Why does one specific drill result like that matter so much?
Well, that grade, 21.58 gram shap, is indeed very high grade. It's a strong indicator of the quality of the remaining resource. It suggests that as they explore deeper or in new areas around their existing mines, they're finding pockets of extremely valuable ore. Discoveries like that can dramatically improve the overall economics of a mine, potentially extending its life or increasing its profitability significantly. These exploration updates are really the lifeblood for a mining company's future growth, and positive results often get the market quite excited.
Got it. High grades mean potentially more profitable ounces down the road. What about external factors? Any market events coming up?
Yeah, there's some potential institutional activity on the horizon. You often see ETF rebalancing around the end of October. That's slated for October 31st. And then the big institutional investors have to file their 13F forms showing their holdings in December. If we see continued accumulation of Alamos Gold shares by large funds, maybe partly influenced by things like the TSX 30 inclusion and the strong performance these filings and rebalancing events could potentially add more buying pressure, affecting liquidity and sentiment positively. And of course, the bigger picture, the industry tailwind from elevated gold prices continues to support revenues across the board for producers like Alamos.
Okay, lots of potential positives, but we absolutely have to balance that. Let's talk about the other side, the risks, the headwinds. What are the concrete concerns, and is there any speculative chatter we should be aware of?
Right, the main tangible risk, the one management has acknowledged, is cost inflation. As we discussed, Q1 saw those higher all-in sustaining costs. Now, management reaffirmed the annual guidance, which is good, but if inflationary pressures on things like labor, energy, fuel, and other materials stick around longer or worsen unexpectedly, it could squeeze margins later in the year and potentially force a guidance revision. That's the key operational risk to watch closely.
Makes sense. And fundamentally, no matter how well they run the business, their fate is tied to the gold price, isn't it?
Absolutely. You can't escape that. The big market risk is always gold price volatility. If we saw a sharp, sustained downturn in the spot gold price, let's say it drops significantly below $3,000 an ounce and stayed there, it would inevitably hit their revenues and profits. That's just the nature of the business. That said, their strong cost discipline and relatively low AISC do give them a better cushion compared to higher cost producers. They can weather lower prices better than many peers.
And the speculative buzz, any rumors floating around?
There is some chatter, mostly unconfirmed online speculation, you know how it is. Two main themes pop up. One is that Alamos Gold, with its safe jurisdictions and strong balance sheet, could become an attractive acquisition target for one of the really big global gold miners looking to add North American assets. The other side of that coin is speculation that Alamos Gold itself might use its net cash position to become a consolidator, perhaps acquiring smaller, undervalued producers to fuel further growth. Again, these are just rumors at this stage. But sometimes that kind of talk can drive short-term interest and volatility in the stock.
M&A chatter always adds a layer of intrigue. Okay, let's try to bring all these threads together. Based on the fundamental picture, the technical strength, the potential catalysts, and the risks, what's the final sort of synthesized investment thesis here?
Looking at everything, the overall stance is definitely bullish. I'd rate it fairly high, maybe an 8.5 out of 10. The case really builds on three core pillars. First, exceptional fundamentals. You've got that sustained double-digit growth combined with that incredibly important, almost pristine net cash balance sheet. That's rare. Second, strong technical momentum. The stock is clearly in an uptrend, holding well above key moving averages, and the RSI suggests it's not wildly overbought, leaving potential room to climb. And third, positive sentiment. You have unanimous analyst support, evidence of growing institutional interest. It all paints a picture of confidence. So you have structural quality meeting near-term potential catalysts. It makes a pretty compelling argument right now.
An 8.5 out of 10, bullish. And who does this opportunity seem best suited for? Is it more for a short-term trade or a long-term hold?
I think it actually fits reasonably well for both horizons, potentially. For a shorter-term trader, the setup looks interesting heading into the Q4 earnings, especially if gold prices remain supportive. There could be near-term catalysts to play. But for the longer-term investor, Alamos Gold offers something more durable. It looks like a robust way to get multi-year exposure to the gold sector. You're investing in a disciplined company with a proven track record of controlling costs, operating in safe places, and consistently outperforming many of its peers. It's a quality name in the space for structural gold demand exposure.
Great summary. Thanks for walking us through all that analysis today. Hopefully, this exploration of Alamos Gold gives everyone listening a clearer picture to decide if now might be the right time for them to engage with this stock.
And maybe just one final thought to leave you with, a more strategic question perhaps. Given Alamos Gold's history of careful organic growth and that really strong net cash position, should investors be thinking about it more as a potential target that might get bought out by a bigger fish? Or should the focus be on its potential to use that balance sheet strength to become a disciplined acquirer itself, shaping the future of North American gold mining through smart consolidation? Something to chew on.
That's definitely the bigger strategic question down the road. Target or acquirer? Food for thought. As always, remember to do your own research. Use this discussion as a starting point, not the final word. Thanks for tuning in, and we'll catch you next time on Investing Talk Podcast.